Good morning and welcome to Chapter 2 of Accounting Principles, Accounting 221. In this chapter, we're going to extend some of the information that you learned on the accounting equation to actually go into some detail about what each one of the components of the accounting equation, assets. Remember, the accounting equation is assets equals liabilities plus owner's equity. And you have to include in owner's equity also revenues and expenses and dividends. And what we're going to do is talk about a little bit more detail about the accounting equation. But what we're also going to do is review some accounts that are going to go into each one. We're going to learn about debits and credits as well and what they really mean in accounting. This probably is the most difficult chapter in the book. If you get the foundational principles off of this chapter and you spend some time with this, then the rest of the material in accounting will be easy. If you don't spend the time here, the rest of the information in accounting is going to be very difficult. If you do not get what I am trying to tell you, I would encourage you to look up other YouTube videos, read other materials, spend some time in your book. Just really spend a fair amount of time in Chapter 2. If you do that, you will learn the material and you will understand accounting and you'll be ready to rock and roll and do well. If you do not, you're going to be in the bottom half of the class and you're going to struggle the rest of the semester. And for those of you that need to take Accounting 2 after this one, you're going to continue to struggle in that class. So I would encourage you to dedicate the time necessary to understand this material. And as we start, okay, the first learning objective, we're going to talk about accounts and how they link up with the accounting equation and describe what those common accounts are. Here's the basic accounting equation as we covered in Chapter 1. Assets equals liabilities plus owner's equity. Each one of those, and you notice in the bottom here it says, an account is a detailed record of all increases and decreases that have occurred in the account during a specific period. So let's use a couple of different examples. For you, if you get a bank statement, some of you will get it electronic, some of you will get it on paper. But when you get in a statement, that's really a statement of your account. That's your given bank account. And it might be a savings account, it might be a checking account. But typically you're going to get a statement of your account done. And what that statement is going to tell you are the ins and the outs of your account. Well, it's the same thing in accounting. Now, what you would call that for you as an asset, you would call that cash. Now, the opposite of that is some of you guys have credit cards, and if you don't, you might have one later on in life. You'll also get a statement of account for your credit cards, and that's going to be all the ins and outs. It might be if you return something. It might be when you buy something, also when you make a payment. That's going to be the ins and outs, and that's going to be a statement of account. In accounting terms, that's probably going to be accounts payable. So that's going to be a liability. I just want to kind of give you a perspective so you can wrap your head around a little bit based off of your life, what accounts are good and what accounts are not good and how you can relate those to what you do in the real world. Okay, so let's talk about accounts. First, we're going to talk about assets. Now, I would paraphrase assets as something that you own. And you have several different types of assets. You have cash, which we talked about, cash, and it's really cash in the bank. I mean, typically they'd say cash. You can also have something called petty cash, which in some businesses that might be a box that they use for small routine purchases. You may also have impressed cash. That's for some of you that work in a store, and when you start the day out, they'll give you a cash drawer and it'll have a certain amount of money in it. That's also considered cash for a business. But the big thing with cash is going to be money in some type of a bank account within a banking institution. Accounts receivable is another asset. Accounts receivable are what you expect to receive. If you provide services and you expect the customer to pay you later, that's accounts receivable. Notes receivable is a little bit different. Notes receivable, unlike accounts receivable, has interest on it as well. So it's a little bit different because you'll see that there's interest associated with notes receivable. Prepaid expenses are the payment up front for an expense. Typically in business, they'll charge you for insurance, and what they'll do is they'll tell you need to pay 6 months worth of insurance up front. And you don't want to expense all those at one time, that expense. You're going to expense it 1/6 each month. That's why you have an asset called prepaid insurance. And then you have equipment Furniture and fixtures. The equipment, furniture, and fixtures are basically stuff that you have, and you might hear this term also long-term assets. In fact, the last three you might hear them called long-term or long-lived assets or fixed assets. So that's what you're going to see for building, land, and equipment. And they report these on their balance sheet at historical cost. What they paid for them is what they're going to put them on the balance sheet for. Okay? Liabilities, in contrast to assets, liabilities are something that you owe, something that you have to pay in the future. Accounts payable are going to be bills that a business has that come in on a monthly basis. The water, electric, and gas bill are examples. For you personally, accounts payable may be your cell phone bill, your tuition bill, your rent, all things that you pretty much pay monthly. Now, the next one is notes payable. Notes payable will be a little bit different than accounts payable in that in accounts payable there's no interest or no implied interest, whereas in notes payable there is interest. So that changes the concept a little bit. You actually have to pay interest on notes payable. Don't be confused, and this is a little bit of a debate you might have with yourself, and you can ask this question. Are credit cards notes payable or accounts payable? One might argue that they are notes payable because they have interest. But the concept is a credit card is something that you should pay every month. So in fact, they should be, in my opinion, notes payable, but you might have a different opinion of those. And I just want to touch on that just a little bit so you at least think about that concept. And accrued liability are things that you are going to pay sometime in the future. And there's a couple of examples here. It has salaries payable and rent payable and taxes payable. Those are things where they're going to pay something in the future. A good example here is when they take money out of your check for federal income taxes. What they're going to do is when they take that out of your check, they're going to credit a liability called federal income tax payable. And when they have to remit that to the federal government, then they will reduce their payable and reduce their cash. We'll talk about that a little bit more later. The last one is something that people struggle with a little bit with the concept. It says unearned revenue. Now, unearned revenue is a liability. Remember, it's a liability because the company owes that. You say, okay, explain. I can read what it says here, but what's a real world example? Well, let's say you buy season tickets to the Rangers game. When you buy season tickets, the Rangers don't earn that revenue until they play that game. So if they don't play that game, they in fact would have to refund your money if they didn't play the game at all. Or better yet, if they have a team that has playoffs. If they have a team that's going to the playoffs, they think they're going to go to the playoffs, they think they go to the Super Bowl, they collect money up front for those Super Bowl tickets if you're one of the lucky fans to go. If your team doesn't go, your team has to refund the cost of the Super Bowl tickets to you that you paid up front. That's a prepaid revenue. They don't earn it until they've gone to the Super Bowl in this particular case. Equity, or sometimes you hear this referred to as owner's equity or capital. You have 4 different categories, and I kind of like the first 2 are pretty straightforward. Common stock is the first one. That's just the certificates that you own as part of the business, and that gives you rights to the business. And there are stock certificates, and there'll be a picture of this in your book. A dividend, it says here, distributions of cash or other assets to shareholders. I like to call dividends distribution of profits. And what they do is they'll say, a lot of times it'll say, they declared a dividend of 25 cents a share for all shareholders owning on this particular date. And what they'll do is they'll pay you 25 cents per share if you own shares of stock on that particular date, which is the date of record. Revenues, the way I like to look at revenues, cash in, money into the business. It's not quite exactly that, but to get the ball rolling and for you to understand the concept, cash in is a good way to look at revenues. By contrast, expenses are cash out. And really, I want to go back to revenues just for a minute because I think it's important. You notice here, a good rule of thumb is anything that says revenue or fee in it is going to be revenue, with the exception of what we just talked about in liabilities, which is unearned revenue. So that's the one exception that you have is unearned revenue. Everything else is going to be there. Now expenses, The expenses are cost of goods sold. You can have rent expense, paying for rent, salaries, and utilities are typical expenses for a business. And those are really cash out of the business. They're paying for employees, they're paying for the business, they're paying for the utilities, etc. Okay? Now here's a chart of accounts, and a chart of accounts helps businesses organize their accounts into categories. Something that I want to point out that's really not in the slides and it's in your book, look at the first number of each account. So the assets, if you notice, in parentheses you might have a 1 up by assets because all assets begin with 1. All liabilities might have a 2 in parentheses because all liabilities begin with 2. Equity, all equity or capital begins with a 3. And then income statement accounts, and they say here part equity, which it is. It rolls up into the accounting equation there. The revenue is 4s, and expenses are 5. And they're actually 5 and greater. And I've worked in multiple companies, and this is the exact same approach that they've had to the chart of accounts for each one. Okay, let's talk about debits and credits. This is the part where people struggle the most with accounting. The basic stuff that we've been through, you have no trouble. But let's talk about debits and credits, normal balances, and double entry accounting. This is the part that really you need to dedicate your time to understanding to give you a good foundation. Okay, double entry accounting says that you have to have 2 entries always. You always have to have a debit and a credit, which it doesn't say this here, but have a debit and a credit because your journal entry or the accounting always has to balance. You can't take one and then put it to the other. You have to have one. You have to have always a 2-sided entry, never a 1-sided entry. That's a double entry system of accounting. A T account is a representation of an account. And you notice here it's got cash is the name of the account. It doesn't have the account number. You remember it was, I don't think, 111 from the chart of accounts. It doesn't have the account number, but it's a representation of the account. And the debits are on the left side and the credits are on the right. And you can see here just a representation of a T account. And here's one way to look at how increases and decreases of accounts work. To increase an asset, you debit it. To decrease it, you credit it. To increase a liability, you debit it. To decrease a liability, you credit it. To increase equity, to credit. And to decrease it, you debit. So you notice the left side of the equation, the assets you debit and you credit. So you can kind of see what happens here with the basic accounting equation and the T accounts. And you notice here's what you would do to do an entry. And if I want to increase cash, I'm going to debit it. It'll be on the left side of the T account. And if I want to decrease cash, I'm going to credit it. It's going to be on the right side of the account. And here's the expanded accounting equation. I know it's a little bit small, but you notice that assets and expenses have the same character. Assets, expenses, and dividends have the same character. And liabilities, common stock, and revenues have the same character. So if you want to group those, if that makes it easier for you, maybe you can make a little jingle that says LCR, debit decrease, credit increase. And then ADE, which would be assets, dividends, and expenses. You debit for an increase and you credit for a decrease. And we'll talk about normal balances here in a minute. Normal balances a normal balance is the same as the increase. So for assets, dividends, and expenses, the normal balance is going to be a debit or an increase. For liabilities, revenues, and capital, the normal balance is going to be a credit. And there's a table that's on Exhibit 2.5 that explains this to you. So if you look at the increase column and the normal balance column, they're exactly the same. They're exactly the same. And they put in this particular setup, they put the debit ones first and the credit ones second. I kind of like to put it more like in the balance sheet income statement model, but this works as well. So you can kind of get an idea of what's what. Okay? So how do you figure out an account balance? And be careful here because what they show is they only show the cash side. There's other transactions for double entry accounting that would have happened with this particular transaction. And what it shows is you add up the debits on the left side and you subtract from them the credits, and the number that's bigger is going to be your balance. So we had $35,500 in debits and $23,200 in credits. So the balance is going to be $12,300. Okay, let's talk about what we would do to record transactions and then post to journal entries to the ledger. And what we get is we get something called a source document, and that's how we determine when we're going to record transactions. And those particular source documents help us determine where to go. We have to read them and understand what to do with them. So we get different things. We get source documents. We get analyzed. So a transaction occurs. We get source documents. We analyze them, and we determine what journal entries we need to do. Here's some examples of source documents. A purchase invoice, bank check, sales invoice. Those are a couple of examples of source documents. There's multiple others. And you look at the source documents and you determine, based off of those source documents, where you are going to put your journal entries. And you notice here a journal, and it's generally called the general journal, is the book of original entry in accounting. And you're going to post to the general journal. You're going to post information from the journal to the ledger, which is called posting. You're taking information from the journal and you put it in the ledger. That's called posting. So we're going to look at each transaction, and we're going to start with using the accounting equation. Then we'll probably not use the accounting equation go forward, but it gives you an idea. So the first transaction on November 1st, the e-learning company received $30,000 cash from Sheena Bright, and the business issued common stock to her. So cash came into the business. We know cash is an asset from what we talked about earlier. So we're going to debit cash because we're going to increase cash, and really cash in this case will probably ultimately be a bank account. And we're going to credit common stock, which is equity. And we're using the T accounts to do that. But now here's a journal entry. We'll use an accounting equation. Here's a journal entry. And then here's a T account. So you can see each one of these can look sort of the same. So, and a couple things I want to point out on a journal entry, particularly for you guys that are taking this class online. When you take accounting in person, they're going to expect you to do this. The date is in the upper left. The debit account is always on the top, and you're going to put it in the debit column. And you have accounts and explanations. Then the next account, the credit, is going to be on the bottom, and it's going to be indented. So you have debits and credits, 30,000 and 30,000. And you have a description. Typically, we'll omit the descriptions for what we do. And remember, some of this is really kind of old school accounting from way back in the day when they did accounting by pencil and paper. And most accountants way back in the day, you'd see some kind of what they would call green ledger paper or green journal paper. And most accountants would have probably a dent in their finger, and their hand would probably permanently be gray from pencils. But here's the first journal entry. And you notice they talk more about the rest of the stuff that goes on here with the date of the transaction and the dollar amount and all that stuff, the stuff we just covered as well. So this is what the journal entry looks like. So make sure the debit is always on the top, and the credit is on the bottom, and the debit and the credit is indented, and then the description. Okay, next one. On November 2nd, Smart Touch Learning paid $20,000 cash for land. So what we're going to do is on November the 2nd, so we put our date November the 2nd, and then we debit land, which is an asset, so we're increasing asset. If you go back to Exhibit 2.5 and you look at your book and you follow along with each one of these transactions, it will help you immensely. And then you credit cash. Cash is $20,000 because so land came in and cash went out. We reduced cash, but we increased an asset called land. Next transaction. Smart Touch Learning buys $500,000 of office supplies on account on November 3rd. And when you read something that says on account, it's either going to be accounts payable or accounts receivable. Accounts payable is what you expect to pay, and accounts receivable is what you expect to receive. So in this particular instance, Smart Touch expects to pay somebody sometime in the future. So that's a liability, just like your credit cards is a liability. So what we're going to do is we're going to credit accounts payable, and we're going to debit office supplies. Office supplies is an asset that we increased, but we also increased accounts payable as a credit. So that's so what we're doing is we're increasing what we owe, but we're also increasing what we have. Transaction 4. It says on November the 8th, Smart Touch Learning collected cash of $5,500 for service revenue that the business earned by providing services for clients. So cash came in, so we're going to debit cash, remember Exhibit 2.5, and we're going to credit service revenue. Service revenue increased. To increase your revenue account, you're going to have to credit it. And so that's our transaction here. The next one on the 10th. On November the 10th, Smart Touch Learning performed services for clients, which the clients will pay the company later. So what's different about this one? They did something for somebody, but they said, bill me. I'll pay for you. I'll pay you later. Don't expect a check when you're here. Just send me a bill for what I owe you, and then I'll write you a check. So if you had a plumber that came to your house, or maybe you had a heating and air conditioning person that came to your house and did work, and they were just going to work on the outside. They weren't going in the house, and you weren't going to be there, and they trusted you. You'd say, hey, when you come and do this work on my air conditioner, just send me a bill what I owe you, and I'll write you a check. So for the plumber or the air conditioning guy, that amount of money, what you owe him, would be accounts receivable on his books. On your personal books, if you had books, would be accounts payable. Remember, on account is a big deal, even though it doesn't say it here. They expect to receive this. Smart Touch expects to receive this money later. Okay, now Smart Touch paid cash for expenses on November the 15th. $2,000 for office rent and $1,200 for employee salaries. So cash went out. So they wrote 2 checks, and so cash went out. And so we're going to increase an expense account, $2,000. We're going to increase salaries expense, $1,200. And cash goes out, $3,200. So you have 2 debits and 1 credit for $3,200. And this is called a compound entry. Okay, now Smart Touch decided, well, I got to pay those people that brought this stuff in for me. So when they paid them, cash goes out, but they also reduce what they owe. So they reduce their liability for accounts payable by $300, but they've also reduced their cash, which is an asset, by $300. And so they owe less than what they owed before for the office supplies. Transaction 8, they collected money on account. When they collect money on account, what that means is they expect to receive less. Somebody said, so your heating and air conditioning guy, you wrote them a check. Well, when it gets to the heating and air conditioning guy, what he's going to do is he's going to say, oh, now I don't expect to get this money from Rankin anymore. What I do is I have less that I expect to receive, but I've converted that into cash. So I've increased one asset called cash and decreased another asset called accounts receivable. On November 25th, a payment of $5,000 in cash was paid for dividends. Dividends is a distribution in profits. Now understand this is an illustration, so they probably won't do this early on in a business, but this is an illustration to show you what dividends are. So cash went out, and what else happened? We increased dividends, so we debited it. That's the normal balance of a dividend. And the next one, prepaid rent. We paid up front for all the rent, $3,000, and we had cash for $3,000. So $3,000 went out and for cash, and $3,000 for prepaid rent. And it's for December 1st. And then the next one, salaries expense. They paid $1,200 in cash. They wrote a paycheck. They increased salaries expense. They decreased cash. So that's how they got paid. Building. They bought a building for $60,000 and they took out a loan for it. Notice the difference. This one says notes payable, not accounts payable. Well, if it says notes payable, it says that they're going to pay for it in the future and it's going to have an interest. And it's $60,000. And they had the owner, apparently, it looks to me like Sheena Bright, brought $18,000 worth of furniture in that had a fair market value, so she took some stuff from her house probably, or who knows. But $18,000, so they put the furniture on their books for $18,000, and they issued her stock for doing that. So she got stock for putting her money into the business. That's a stockholder contribution. And you have an accrued liability. You get a telephone bill for $100, but they're not going to pay it until next month. And so what they're going to do is they're going to put this on the books for $100 as an expense, and they're going to pay it in the future. And this is an example of something called the matching principle, where we want to match revenues and expenses, because the utility bill is for probably November 15th to December 15th, but they're not going to pay it until, say, January 15th. But in effect, what we're trying to do is match the revenue and the expenses for the business. And then we paid salaries expense. We paid salaries for cash. That's one we've looked at already. And we have this one. This is the unearned revenue one we talked about earlier, like with the Super Bowl. This particular, for this thing, Smart Touch Learning worked with a law firm, and they're going to do some work for them. And they said, well, give me a down payment, because I'm not going to do this stuff until you give me some kind of a down payment. And sometimes you'll see this, say, in a landscaping business. They'll say, pay me a third of the money down before I start, and a third after 3 months, and then the other third when I'm done. So, and then they'll earn their revenue. But that's what this is all about. It's unearned revenue. And remember, unearned revenue, unlike the other revenue accounts, unearned revenue is a liability account, not a revenue account, so it'll be included on the balance sheet. And then looks like they did work, $8,000 for businesses for cash. So they collected their money up front. They didn't do a receivable and expect to receive it. If they had expected to receive it where this says cash, it would actually be debited to accounts receivable. But they basically did the work and got the money when they left. And what we do is we take the stuff from the general journal and we post it to the ledger. And you can see in Exhibit 2.7 what that looks like. And what we want to do is make certain that the assets equals liabilities and total equity. And it's 114,700 is equal to 114,700. And here's an illustration of the assets. And you notice how we balance these accounts. We use the T accounts, which represent the ledger. This is one way to represent the ledgers, using T accounts. And it shows that the balances. And you notice here the cash one, what we did is we added up the debits on the left and we added up the credits on the right. We looked at the difference and it was 12,200. Easier illustration, obviously, is this accounts receivable. We had 3,000 for work that we did that we expected to receive on November the 10th. We received 2,000, so we have 1,000 that's left. So it's 114,700 that we owe, and I don't think you guys can probably see that in your slides, but it's 114,700 total assets. And then we have liabilities and owner's equity, the opposite side of the accounting equation. These add up to 114,700, and these are the balances here. And here's another way to look at it, and this is also from back in the day. But for what you guys are going to do, you do most of your stuff in T accounts, but this is just another way to look at an account. The only difference here, you notice they have the account number, and they have a running total, and these J1s are the J1 or the J2 are the pages. And here's what they look like for posting references. You can see how this part up here is the general journal, and the stuff down here is the general ledger where you're posting. And you might spend a little time with this, but this over here to the right is a running balance. And we're going to prepare a trial balance once we've done all of our postings. And the reason we want to do a trial balance is we want to make certain that debits equal credits. Because if they don't, we made an error in bookkeeping. So here's a trial balance. And you notice here, it starts with assets, then it goes to liabilities, and then equity, and then the subcomponents of equity, service revenue, rent expense, etc. And if you see something that says fees on the end of here, it might also be service fees, might be another thing that you charge out. So here's a trial balance, 125,400 and 125,400, and they balance. And really, if you were to draw a line from here up, common stock, that's going to be the balance sheet, and from revenue down, that's going to be the income statement. And dividends, there's a bridge in the middle, which is called retained earnings. So you can do a set of financial statements, but you want to make certain you balance. And you prepare financial statements, which we looked at from chapter 1. And remember the order. You go from an income statement, the statement of retained earnings, to the balance sheet. A couple things to point out here. The header, and this is for 2 months ended December 31st, 2016. For 2 months ended December 31st for the statement of retained earnings. You need the net income to put it on to the statement of retained earnings. There's no beginning balance because it's a brand new business, zero. And they paid $5,000 in dividends, so the $5,800 from the statement of retained earnings goes to the balance sheet, and then you have the assets. And basically you have what you would call current assets, which are going to come due in less than a year, and then long-term assets, and you do the biggest to the smallest, generally speaking. And then the same thing, the liabilities over here as well. And current and long-term. The current ones are towards the top and the long ones on the bottom. And you sum these two together, and then you add in the equity. Don't forget, add in the retained earnings. Don't forget to add in retained earnings when you're making your calculations. If you have errors in your trial balance, you need to go look for them. There's two broad kind of errors that you can find. One is if they're divisible by 2. That means that if you find a number that's divided by 2, and if you see that number in one of the columns, check and make certain you have the right balance in the right column. You might have the debit in a debit in the debit column, and it should be in the credit column, or vice versa. You also might take a look at something if your error is divisible by 9. So if your number is 81 or 8,100, if it's evenly divisible by 9, you probably have a transposition error. And what that means, transposition would be that maybe you wrote down 1,800 and it should have been 8,100. That's where you're going to have a transposition error. That's what a transposition error is all about. That's it for chapter 2. I encourage you to spend time on this chapter. This is the most critical chapter in the book. If you get this chapter down, the rest of the material will be easy. If you don't get this chapter down, the rest of the material is going to be very hard. And I want all of you to succeed, so please heed my advice and work through the chapter 2 homework and do well on the chapter 2 homework, and really dedicate your time and resources to this right now, because if you do, you'll have success in accounting, and you will not fear accounting, you will embrace accounting. I wish you well today, and I hope you're having a great fall day or spring day, depending upon when you're listening to this. And I look forward to chapter 3. Thank you.